Cool. Yeah, so hey everyone. Now we are gonna go through step 6 through step 8. The first thing we're gonna start out with is calculating the terminal value for step 6. So the terminal value kind of just represents, if you think about a company, you project out their cash flows, and then a corporation, lives indefinitely. So the terminal value is estimating all the cash flows that this corporation will generate after your projection period. And then, in most typical DCFs, your terminal value represents about, 70, 80% of the value of, the DCF. And that's because, the terminal value is such a longer period of time rather than the projection period. But yeah, so this is where we're going to start, actually calculating our implied price. So we'll start with our projection period free cash flow. This is just going to equal the sum of all these projected free cash flows right here. And then for our actual terminal value, we're going to use the formula that's on the Apollo DCF guide that we sent you. For the terminal value pretty much implies that that the corporation will grow at a specific growth rate indefinitely. That growth rate, we tend to use a number between GDP and inflation. The reason you don't want to go above, historical GDP is because if you're saying the company lives forever and the company's, long-term growth rate is above GDP, that's pretty much assuming that the company's, going to grow faster than, the U.S. And eventually this company will be so big that it will take over the U.S. Economy. So in order to be conservative, and because no company can grow at that rate forever, we'll use a historical GDP number, which for this example, we're going to use 2%. So yeah, for this terminal value, the formula is going to be your terminal year or your 2025 cash flow times 1 plus this growth rate up here, which is the 2% perpetuity growth rate. And then we're going to divide all that by the WACC minus the growth rate. And that's because we have to discount this. And then you're actually, so, if you think about that right now, you are calculating next year's cash flow, discounting it back to 2025. Now, in order to get that in the present, you have to discount that 2025 cash flow back to where we are in 2020. So I'm actually going to add parentheses all around this. And then I'm going to discount it back to the present, similar to what we did before. So that would just be dividing by the discount rate plus, or I guess for the sake of consistency, 1 plus the discount rate to the 5th power here, because we're in 2025. Cool. Does that look right, Yosh?
Yeah, I think so. Numbers seem to be matching up there. I think we can keep going.
Okay, cool. Yeah, so enterprise value is just going to be the sum of these two sets of cash flows, because these cash flows represent the value of the company as a whole. So we'll just sum these up. In order to get to equity value, so enterprise value, our formula for enterprise value, with enterprise value, we're estimating the value of the total firm. So it includes both debt holders and equity holders. But in order to get equity value, we have to subtract out net debt. So net debt is just your debt minus your cash. So up here we have debt, and then we'll subtract out cash. That's our net debt. Our equity value is just going to be the sum of these two. And then our diluted shares outstanding should have up here. Yep, right there. And so we have equity value, we have our shares outstanding. In order to get our implied price, it's just a simple division. And that's not right.
I think it might be in actually let's go back to the terminal value. I think we have to parentheses.
There's an issue here with our parentheses.
Check the last one and put all that in another own thing.
Yeah, good call.
No. You can pause too if you need to.
Yeah, good call.
We pause.
Yeah, I'm looking for it right now.
Why don't you?
Here it is. All right, so we ended up figuring out the issue. Obviously, it's a problem when your implied price is almost $800 above your current share price. And the issue with that is the discount rate or the WACC. As you can see, changing the WACC, just for just to like kind of show y'all the way this works. So the WACC's at 2.59%. Having a lower WACC drives your implied price up. So just for sake of an example, let's change this to 4%, and look what happens to the implied share price. It changes dramatically. So that's why that WACC is so important. And so something we do in Smith that we also want to teach in Apollo is using a hurdle rate for our cost of equity. That hurdle rate we usually do is 10%. So the way that works is, so we have our cost of equity of 2.77%. Because we're investing in a portfolio of stocks, if this makes sense, we want all our stocks to kind of have a consistent rate of return that we require, and that would be this hurdle rate of 10%. And we blend this hurdle rate with our cost of equity right here. And then we use that blended cost of equity into our new WACC formula right here. And so going back to our free cash flow model, let's see how this changes our terminal value. So we're going to go over here, and this WACC is going to change to our blended WACC, which incorporates the hurdle rate. And my bad. And then this right here, we need to change this to our blended WACC as well. And there you go. Look at the difference in price, and that's a lot closer to our implied share price. So it makes a lot more sense there. Something we also have to do now, though, is go back and fix these present value of our free cash flows because we were using our smaller WACC for these. So thinking about this logically, if we change the WACC and make it bigger, it's going to be a bigger number on the bottom, which is ultimately going to make our present value smaller. So here we will change this to our blended WACC. We'll press F4 to absolute reference it so it stays locked in place. And by doing that, we can just drag this over, hit Control R. Control R, and look at that. So now we have our new present value of cash flows. These are all discounted using our blended WACC. And because we did the absolute cell reference, it let us drag over smoothly. Cool. So now you can see that our implied price is about $117.32, which is still, far a bit lower than our current share price. But it's a lot more realistic than we had before with the 900. Cool. Yes, do we want to go do this current price now, or go straight to the multiples method and do that at the end?
Yeah, we can do that. We can go to, I guess we can try out multiples first, and then we'll come back to doing the current share price of each.
Okay, cool.
Or the premium
So,
transfer. Yeah.
cool. So yeah, now we're going to go over to our comps. Just to reiterate all this, I'm going to try to like say all these Excel shortcuts every time I do them, just to help y'all out. To move over without using your mouse, I'm going to hit Control Page Down, and this is going to move the tab over, and now I'm on the comps. And so these comps are a bunch of different multiples and operating, what do you call return on? It's an operating margin or an operating figure. And so now what we're trying to do is say, hey, like Walmart has a bunch of competitors that are similar in geography, size, financials, etc. Those are kind of some of the key metrics you use when comparing two comparable firms. So we're going to say, hey, Walmart has these competitors. If they are similar companies in general, then Walmart should trade in line with its competitors on a multiples basis. So in order to do that, we're going to calculate the median of all these multiples for its competitors. In order to do that, we can do the equals median function, and then we'll open that up. And because we are, valuing Walmart compared to its other competitors, we don't want to include Walmart in the median calculation here. But yes, we'll do that. Close the parentheses. Over. So our median price to earnings multiple is 14.7 times. We can drag that over, and it calculates the median for all of these. High. These are more just for kind of show and just kind of, these won't be used in actual calculations, but if you wanted to show someone like, hey, like, these are my comps, this was the biggest, this was the smallest, this is kind of, the reason we do for that. So we'll do max here, and then here we'll do min, close the parentheses, and we'll drag that over, Control R to move it over, and there you go. Cool. So in order to value Walmart's terminal value using the multiples method, so before we talked about there being the perpetuity growth method, which is saying that the terminal value is based on a long-term growth rate, that long-term growth rate being GDP. In practice, you'll find that a lot of companies use the multiples method because it's more in line with true, market expectations, market figures, because, Walmart competitors actually trade for this number, like this is real data. So in order to do this, we're going to use the median EV to EBITDA multiple from our comps. And then,
real quick.
Oh yeah, go ahead.
So you guys see how there's actually these percentages aren't correctly formatted right here on ROA all the way to our operating margin. They have the wrong, I guess, system of the formatting. So Jacob, can you do this on your side since I don't have the shortcuts? So just highlight all the way over to the right and then the 3 rows down, and then hit Control 1. So then now you can go over to just percentage and then do like 1 or 2, however it was, and then you can hit OK. And then it'll change it to actually what it needs to look like. All right.
Yeah, thank you for that. So yeah, definitely, that makes a lot of sense. ROA is a percentage rather than a multiple. Cool. So we have our median EV to EBITDA. This is going to be the multiple we use to calculate Walmart's terminal value. We're saying, Walmart's terminal value, the long-term value of the company past our projection period is going to be in line with its competitors. So in order to do that, we're going to come back here. In our assumptions, we are going to take this terminal multiple and link it. Remember, control page down lets me go over to this tab without using my mouse. And so we're going to link this median EV to EBITDA to our assumptions. And so now we have our terminal multiple. So going down to our multiples method, our projection period free cash flow is going to be the same thing, just the sum of these free cash flows, the present value of those that we calculated. And then the difference here is going to be the way we calculate our terminal value. The way we calculate our terminal value for this is, all right, cool. So for this terminal value, our formula now, so we have an EV to EBITDA multiple. In order to get our terminal value, we're going to multiply that multiple by Walmart's 2025 EBITDA. So if you think about that, we have a 2025 EBITDA multiplied by an EV to EBITDA. The numerator and the denominator of EBITDA cancel out. So that multiplication gets us our enterprise value, which is what we want. We want that terminal value, part of the enterprise value. Yeah, so to show this, we are going to take that 2025 EBITDA number. We're going to multiply that by this median EV to EBITDA terminal multiple that we got. And just to make sure this calculates correctly, I'm going to put parentheses around this. And then similar to what I did before, I'm going to divide that by 1 plus our blended WACC. And then take that to the fifth power right here to get it back to the present value. Cool. And you can see it's relatively similar to our perpetuity growth method, but there are slight differences. And if you can see, Walmart kind of trades at a premium compared to its competitors. So its EV to EBITDA median, the median EV to EBITDA multiple of its competitors is lower than Walmart's EV to EBITDA. So it kind of brings down that terminal value. Again, enterprise value here is just going to be the sum of these two right here, minus our net debt. To illustrate this again, we're going to go up here. It's going to be our debt minus our cash. Just another shortcut. So, I could click up arrow, up arrow, up arrow, up arrow. It's kind of time consuming. To move quickly around the sheet, I can hold control and then go up arrow. And this just quickly lets me jump up here. And then so I'll subtract the cash out, close the parentheses, hit enter. Same net debt as the perpetuity growth method. Equity value obviously is going to be the sum of these two. And then our diluted shares outstanding, just like above, is going to be right here. And then our implied price is going to be this equity value divided by our diluted shares outstanding, 111.65 cents. So now we're going to show, we have our implied price. We're saying, hey, we think Walmart is, worth between $111 and $117 a share. Currently trades at 143. So, if you're thinking about this from an investor point of view, you might want to actually short Walmart, because you're saying, hey, I think its implied price, I think Walmart's worth a lot less than it currently trades for. We think the market is, overvaluing Walmart for some reason, whatever you think it is. So you'd be bearish on Walmart and possibly want to short it to make money. If this implied price was above our current price, let's say we got an implied price of 160, we're saying that our model says that Walmart is worth more than it currently trades for. The market is undervaluing Walmart for some whatever reason. So we might want to purchase Walmart stock, and the hope is that the Walmart stock will trade up to that 160 that we valued it at over time, and that will be our return, the difference between those two. Yeah, so as we said before, premium indicates the current share price is above the implied price, while an implied discount indicates the current price is below the implied price. So yeah, so here we're going to get our current share price, which will be up in our assumptions. And then our formula here to calculate whether it's a premium or a discount. Obviously, it would be a premium because we're implying that the share price should be a lot lower than it is now. We're going to do open paren our implied price minus our current share price divided by our current share price. And obviously, it's negative because it's a premium. Here, we're going to do the same thing. Take our current share price from up here. And then we're going to do, as we said before, current share price minus implied share price divided by current share price. Wait, let me, oh yeah. So I messed that up. Just see the mistake right there. It should be price implied minus this current share price. And that gets us the negative 22.38%, which you know, indicates a premium today's current share price. Now we're going to do our sensitivity tables. And so, you know, the key point with the DCF is, you know, not that we're trying to say exactly how much a company's worth. Oh, you know, no one can go out there and say Walmart is exactly worth $117.32. That would be, you know, insane if you could do that, because that's so exact. And, you know, we don't, we're just, you know, human. There's always error in everything we do. And no one can be for certain what the price of Walmart is, but we can give an estimated guess as to what the range of values we think Walmart is worth. So we want to show a range of values and say that this is what we think, here's the upside and here's the downside. In the future, just for reference, we did this in Smith and you may do it in Apollo depending on the sector. You'll actually create 3 different DCFs, a base case, an upside case, which, you know, has higher assumptions. Maybe we change its revenue growth rate from 1.68% to 2%, and then a downside, which might be a 1% revenue growth rate. And we'll change other things about the DCF, just trying to show that, you know, here's the best case scenario, here's the worst case scenario, and here's the range that that falls into. Yeah, so now we're going to do our sensitivity tables just to show the range of, you know, values we think this company could be worth. And here you have all the directions right here, but in order to show you, so this is connected to that C44 for our perpetuity growth method, our implied price. In order for this to work, this has to be hard coded. And then this WACC also has to be hard coded. This is just something funky that, you know, you have to do when making the sensitivity tables. So in order to hard code that WACC, I'm going to control copy, control C, and then I'm going to do a paste value shortcut. So I'm going to do Alt ES V. It's going to paste the exact value in there. And now I got my 5.81% in there. Now we're going to say, you know, what happens if we increase the perpetuity growth rate by 0.25%? How is that going to affect our valuation? In order to do that, we're going to take this 2% and make it a range of values. So we're going to add on our perpetuity step right here. And I'm going to lock that in place. That way I can just drag this over. And then this will be, you know, the 2% minus the perpetuity step. Unfortunately, I can't drag it over like I did before, but I'll just quickly do that again. And there we go. Now we got our range. And now we're going to do the same thing for the WACC, saying, you know, what happens if we change our WACC up or down by 1%? So yeah, we'll do that plus our WACC step and hard code that, drag it down. And this will be that minus our WACC step. And that minus our WAC step again. And you could really do anything for these steps, but you want to do something that kind of makes sense. Like if you did a percentage point for the perpetuity growth, it'd be like 2, 3, 4. That doesn't really make sense because US GDP is not going to be growing at 4% long term, and that hasn't in the past, and we're not really expecting it to grow like that in the future. Another thing to note that I just thought of is for that perpetuity growth rate, we're using US GDP because Walmart is an American company. Say you were, I don't know, well, let's think of an international company, Alibaba, a Chinese company. For that, you wouldn't use US GDP, you'd use China's GDP, which is a lot higher than US's GDP because Alibaba mainly serves Chinese customers, if that makes sense. Cool, so in order to get the sensitivity table, we're gonna highlight all this, and then we're going to go to data, what if analysis, data table. Our row input cell is going to be that 2%, but in order for the sensitivity table to work, we have to click on it over here because this is linked to the rest of the model. Our column input is going to be this 5.81% blended WAC, and then we're going to hit OK. And in order to know that you did this correctly, the implied price you got using the 2% perpetuity growth and the 5.81% WAC should be the same as the implied price down here. And you can see here it matches 117.32, 117.32. What you're showing here is, hey, what if I keep the WAC the same and increase the perpetuity growth rate by 0.25%? Maybe I'm bullish on GDP growth for the US moving forward. That's going to make my implied price a lot bigger because you're saying Walmart's terminal value grows at a higher rate. Same thing, vice versa if you bring it down. Let's say that, investors require less of a return, and we're going to bring Walmart's WAC down to be more in line with the WAC that we calculated initially. Bring that WAC down 1%, keeping the perpetuity growth rate the same. It brings our implied price up, what is that? Almost $50, which is a huge change. And it just kind of illustrates how much changing the WAC even a little bit, can affect your model. So here we're going to do the same thing. Again, we need to bring this terminal multiple over. So I'm going to do the paste value special, alt ESV, and then our WAC. We're going to do the same thing again. Control copy, alt ESV. And one sec. Cool. And so now we have this, and now we're going to do the same thing we did before. This time our terminal value multiple step will be 1 times. Hard code that, drag that over, and this is going to be minus at 1 times. Same thing here. Cool. And we're going to do the same thing we did beforehand with the WAC, adding that 1% WAC step. And just making sure. In order to see what this cell is linked to, I can hit F2. It opens the cell up. And I come down here and I see the blue highlight right there. That just makes gives me confirmation that my implied price is, this is the right cell, that it links to that multiples method implied price. Now I'm going to do the same thing as I did before. Another shortcut to highlight this whole thing quickly. I'm going to do Control Shift down, highlights down, and then I'm just going to hit right while holding Control Shift all at the same time. And now I'm good. In order to get to data, I can do Alt A, as you see up there, W for what if analysis, T for data table, and then our row input we're going to have to do with our mouse. That's just going to be our 9.9 times multiple. column input is going to be this blended whack. And yeah, just to check here again, 111.65 in the center, 111.65 there. So we are good to go on our sensitivity tables. Do you have anything to add to that, Yash?
No, I think that's pretty good. The only thing I would say, like, we have the current share price at 143 or whatever it is, but just back in July, it was at around 119. So in terms of the actual run up that you see, there might be some other factor that we're not considering right now. So the DCF itself is actually valuing the company pretty accurately, given the fact that just 3 months ago, it was at this share price. And it kind of shows you some of these numbers that you see within the DCF affect the valuation a lot more than other numbers do. For example, like we said before, just look at the WACC. It's a $52 difference. We drop it from 50 or 5.81 to 4.81. Rather than, let's say, if you jacked up the revenue to 2%, it wouldn't be as much of a difference. So that's something to be cognizant about whenever you're looking at certain numbers within the DCF. Make sure that you understand which ones have more weight, and having more precision on certain numbers is more important than other numbers, if that makes sense.
Yeah, definitely. I agree with all that was said right there.